Alf, we are on the eve of potentially the Fed cutting rates. And I think people are talking about 50 basis points. I think that is kind of like status quo. Some people are asking for more. Some people are predicting less. I'm wondering, what is your prediction? Do you have a prediction that is just different from what the market is looking for?
Not anymore, but 12 days ago or 2 weeks ago, if you would have asked me, I would have said 50 basis point. That was completely out of consensus. Now the market is pricing in 56% chance. So we're basically coin flipping. I think the Fed is going to go 50. And I think there are a couple of reasons. First, well, they go 50, not necessarily to panic, but because, as Ryan said before, they should have cut interest rates in July already. So basically, they missed the window there. They made a mistake. Now they see the economy deteriorating. What's the sense in being stubborn and not catching up to basically the cut that you missed in July? Now, people tell me, yeah, but that's because markets are going to panic. Well, it depends how you communicate about it. If you say, look, this is a 50 basis point cut because we need to start and get started properly because we basically made a mistake in missing July. We're honest about it. Now we think we cut by 50 and we make up for it. And then going forward, we're going to observe the economy. We know it's weakening, so we're going to have your back, basically. We're going to try and ease proactively rather than waiting. I think the market's going to be fine with it. The other thing is the next meeting of the Federal Reserve is in November. So now if you cut only 25 basis points after skipping July and the economy weakens further, holy crap, man, you have to wait all the way until November to be able to cut again. And it's a few days after the elections as well. I mean, if I were them, I would just try to put the 50 basis point in and then, have some insurance cuts being basically done. And then in November, observe what the outcome of the elections is. And, effectively, I don't see any big reason why the Fed should go 25 at this point. It's just probably not very smart risk management from my perspective. But again, I'm a macro investor. And from my perspective, it doesn't matter what I want the Fed to do. The Fed doesn't give a crap what I think they should do. So it's always about reading their incentive scheme. What is that they want to do? What is their objective? And their objective right now has moved from slowing inflation to making sure the labor market doesn't crack completely. So they are in insurance mode. They're late, but they're understanding they need to do insurance cuts. They need to come in strong to try and put a floor under the economy.
They need to come in strong. So would you say that a 50 basis point cut, would you characterize that as moving with haste, like kind of on the more aggressive side, whereas 25 bips might be just a little on the timid side? How would you if we do see the 50 basis points cut, how would you characterize how immediate and action bias the Fed is being?
I would characterize it as trying to repair the mistake of not cutting in July, pretty much. And so that's the least the Fed can do. They should do 50 basis points. They should communicate. They understand the economy is weakening and they're ready to do more. Easing coming. Look, the bond market is already doing the job for them, guys. So they need at this point, I think, to fulfill what the bond market is asking them to make sure the stock market doesn't tank, right? And so you should understand global markets are always interconnected, right? It's not like the stock market is a brain and the credit market is another and the crypto market is another. It's all one thing, it's a big, giant puzzle, and investors look at different asset classes. And so today, stock markets are still doing okay. They've had a drawdown, but they're still doing okay. Why? Because they're relying on the cuts that are priced in the bond market. And right now, we have 250 basis points of cuts being priced for the next year. That's a lot. That means slashing rates from 525 to 275. It's a much more friendly rate, 275 in 1 year. Now, if the Fed doesn't fulfill this, well, I think stock investors can get nervous because all of a sudden they see deteriorating data, but they don't see the Fed fulfilling what the bond market is pricing in. So here the Fed has to thread the needle very carefully and come in a convincing way, telling people, you're right, guys. Bond guys, you're right. I understand what you're trying to say. I see the economy is slowing. I need to basically cut interest rates. The bond market is suggesting the Federal Reserve what they're supposed to do. And I think here, given the constellation of macroeconomic data, I talked about the labor market, but there is more under the surface going on. Also, global economic data. I mean, look at China, guys, frankly. It's the second largest economy in the world. And they're imploding. They're basically imploding. And you watch them and you're the Fed and they are your biggest trade partner. They are imploding. Your own domestic economy is slowing down. You have rates at 5.25%. It's really high. So it's more about risk management and insurance here. And the Fed should come doing 50 and should be also pretty dovish in their language.
To continue leveling up your crypto game, then you need to get on the Bankless newsletter. It's the world's most popular crypto email and is completely free. Just click below to sign up.